Hi, everyone. Good evening. Thank you for joining us. We appreciate all of you being here with us on a Tuesday evening. Uh, the idea of doing this call is to, you know, FY25 has been a very interesting and eventful time for equity markets. In the past 6 to 9 months, we've seen a lot of events unfold in domestic as well as global markets. The latest one being the budget, uh, and we thought that we'll take you through our thoughts on this event and also how we are looking at the markets and just kind of a brief insight into the portfolios. I am extremely happy to have Anand Shah with us on the panel. Anand is our CIO for Equity PMS and AIF Investments. Over the course of the next 45 minutes, the idea is to take you through how we are looking at the larger picture from our lens, and then we kind of address most of the queries. So Anand bhai, thank you for joining us. Over to you.
Thanks, Shahzad, and welcome once again to one and all. Uh, what I'll do, I'll try and maybe next 15-20 minutes, maybe 25 minutes, I will try and cover the points I want to make, and then maybe I don't know how we are doing this for, but there can be some time left for Q&A. Shahzad, they will be able to type their questions on the question box or something. How does it work?
Anand, we'll basically just take few questions. We've collated some questions, so we may have time for just 3-4 questions. So predominantly, we will
Yeah.
hear you.
Thanks. So then let me, see how it works. So let me start with a little bit on budget, and then I'll follow it up with how we see markets, what to expect from markets in the calendar year. So in a way, it's also an annual outlook thing. From our end, we have uh, written a lot on the annual outlook. We have also come out with a budget note. So please feel free to reach out to us and ask for those notes. Those notes would be available. Uh, Let me do a small part of that, and let's see how it goes. So coming to budget, I think broadly speaking, it's more of a continuity, while uh, the last part of the budget where almost a lakh of a crore of benefits given to the middle class, largely people earning between 10 to 50 lakh odd rupees. They have been given some benefits in terms of a lower tax. The rest of the budget seems more or less okay. So, if I go back into the last 10 budgets, the mood is all about fiscal discipline and more focus on capex and continued focus on lower revenue deficit. I think that still remains. But if so, not much surprises here as far as the revenue is concerned. And even on that, to be very honest, we're still expecting uh, the income tax to grow at 14.3%, which is even adjusted for a lakh crore is almost 22%. So we don't know where this is coming from. This has been the growth rate in the near past. My colleagues tell me that the tax buoyancy is good and the compliance can improve. But nevertheless, this 22% looks a little aggressive, but so be it. But otherwise, there's not many surprises on the revenue side. Very clearly, the revenue expenditure is growing at 6.7, and capex is growing at 10%. People are a little disappointed with the growth in the capex number, but the way we see is, uh, and I'm subsequently talking about both the revenue, uh, the consumption boost that has been given, but our take is that there is enough and more capex boost still left for FY26 in this budget. So otherwise, rest is is more continuity. As I said, the fiscal deficit absolutely clear that we want to maintain fiscal discipline. In a way, when I'm talking to my colleagues and talking to the experts here, I think continuity with Baton now passed on to other people. So one and foremost, both a lot of work to be done by RBI to ease the liquidity situation. Can you lower interest rates a little more and support growth? So that's one. Baton, if you maintain fiscal discipline, that is what RBI can do. The other one is basically nudging the private sector to do more capex, be it through PLI and others. Again, I'm covering that in a bit. Nudging states to do more. So even if you see this capex number, basically here a lot of that number, which is capex loans to states for capex, is growing strongly at 20%. So very clearly passing on baton to states to do more of urban infrastructure, more on water, more on electricity and others. So I think partly that, and with this income tax boost or the lower taxation boost, and especially the middle class, which can use that money to consume, can use that money to invest into new house. So that's also an opportunity where the households can do more capex. Households can invest and buy a second home because a deemed rent is sort of something which has been sweetened more to buy another house. So I think in a way, this is a continuity budget with fiscal discipline, with an eye on capex, but with a twist that the more is expected from others while the center continues to do the capex. So moving quickly into the few specifics of the budget, just for the information, as I said, it's major beneficiaries will be the households earning between 12 lakhs to 50 lakhs, saving taxes by 2 to 5%. It's a substantial amount of anything between 50,000 to 1 lakh 10,000 is what can be saved. And that's almost 20% of the total taxpayers in India. So I think it's a very decent boost, which is widespread across 20 odd million people. Uh, as I said, the tax buoyancy looks difficult, but nevertheless, we have seen that the tax buoyancy over 10 years is also strong at 1.6x the GDP growth rate. So that is one. The other one being maybe more compliance, better compliance. That's been another, what would I say? It's been the case of late. The tax growth has been strong. So I think, nevertheless, if there is more spending and more consumption, that would help on the indirect taxation, which is GST as well. So that's one missing number that we are not able to. Otherwise, it's a reasonable budget. Um, on the capex, as I said, we are not that disappointed, except that it's more indirect capex than direct capex. Capex in terms of grants to create capital assets, or capex uh, basically which is classified as revenue expenditure like Jal Jeevan Mission and others. But very clearly, my colleagues have put this chart together for you to show that actually the last number can be as high as 17. So again, how you cut and slice the number, but depending on the revenues and depending on how you are able to execute, there can be still some room left. But nevertheless, this is not the end of capex story of India, is what we're trying to say here. But nevertheless, uh, when I'll come to markets and sectors, maybe we'll touch upon that. The market from here is more bottom up, not top down. People would love to know abhi consumption kharidna hai ya infra kharidna hai ya capex kharidna hai. I think it's all and none in that sense, that it will be more stock specific from here on. Uh, uh, yes, this is another added, as I said, passing on the baton. The additional thing which we're talking about is how can we induce more private sector capex? How do we induce more corporates to spend more, because they have money? So in last 5 years, there has been a strong cash flow generation in the India Inc. They have reduced their debt. Their capacity to do capex has increased, but they're not yet doing capex. So these additional benefits given to a specific segment of the market where government wants private sector to do capex. Coming to now outlook, but before I come down to the market outlook, I think a very important one is, and this is something which will be now regular, which is the world of uncertainty. I think in last 2 days we have seen two diametrically opposite markets. The markets where yesterday were the equity markets where we were damn sure that there will be tariffs in the world, and today is a market where we believe there will be no tariffs in the world. So can imagine how in a matter of 24 hours things have changed, but that's going to be the future. Nevertheless, there will be more uncertainty, especially with the current regime. You will see more talk around tariffs. I would want to believe, or rather at least the fact which is there in front of your screen tells you that while India would be impacted, relatively it will be impacted less than the other markets, China being the most impacted, given that they have the highest trade surplus versus most of the major economies, and their consumption is slowing down. Whereas for India, it's opposite. Our consumption is remaining still strong. It's given a further boost, and we are not yet doing capex for the rest of the world. So I think there's ample possibility of consumption picking up, and the demand from the rest of the world both will induce a round of a private sector capex. That's something which is we still believe is possibility. Within the various impact of tariffs, again, the goods would be more impacted than services. Again, that's an advantage for India. But net, we believe, and the way we see the market going ahead, this will all induce China to do some stimulus. China has to induce some consumption because China can't, it's such a large economy, can't be compensating their own slowdown with exporting to the rest of the world and creating all sort of manufacturing crisis in the rest of the world. So our base case is still that there will be some stimulus coming through from China, and that is when there will be some balance of manufacturing and consumption in China. And to that extent, the net exports out of China, which has been brutal for many a manufacturing industry, can reduce. And we will see a little better profitability across the manufacturing value chain. That's been a little bit of our understanding of the market. That brings me to the markets. I think that is where we are all here to understand what all the budget and the tariff talk and the demographics of India, which is very strong, and that would in turn make sure that in the long run India remains the fastest growing economy or among the fastest growing economies, and the wealth creation. So this is one chart, and it's one of my favorite chart. Over the last 25 years, the markets have done what they've done is in front of you. It's delivered something like 14.4% CAGR. These are at the index level. But I think the other message in this slide, apart from wealth creation, is been the market corrections. I think this is one message which is very, very important and relevant today. That this wealth creation, which is superior to most of the other asset classes. Market's been good. We all know by now, most of us understand that equity is a good asset class, and its wealth creation capability is good. I think what has market done over the last 4 years is because the volatility was so little, we forgot that it tends to be very volatile also. So this is just a catch up on the last 25 years, and see various times when the markets have corrected in excess of 30%, in some cases 15 and 18%. But this is the real second part of the market, which is this was a .com. This is the UPA won victory. Vajpayee lost election. Market came crashing down at the lower circuit on that day when Vajpayee lost election and India Shining campaign failed, and Dr. Manmohan Singh became the prime minister. Then obviously we had a mother of a bull market, but we had a very sharp correction in between, which had nothing to do with India. It was as high as 32%. But that's the key thing, that Yeah, this was to do with China's slowdown leading to metal prices correcting globally. That led to a 32% correction in our markets. And this is the global financial crisis. This is the policy paralysis in India, taper tantrums around that time. There's a post-Modi victory. We had a correction. A lot of reforms, the short-term pain for long-term gain were taken. And obviously, this 38% is a COVID correction that we all remember still very strongly. And then there are some small corrections in between. But the point here, the message, the belabored message, or the simple message on this slide where I'm talking so much is basically saying that while the equity as an asset class is great asset class for wealth creation, in the same breath, it is also an asset class which is fraught with uh, short-term risks. So it is not risky, it is volatile. Risky is when you have a permanent loss of capital. And that is something which this slide clearly tells you that if you have patience and if you have a long-term horizon, this market tends to create wealth. But in the short term, if you have come for the short term, you come for the wrong mindset, then this sharp corrections will lead you to exit the market, and then it becomes a permanent loss or it becomes a risk. Some additional data slides on the corrections. I think 20% corrections are not unusual, but they have not been there for some time, especially since December 10 or December 14. They have been far and few, and very clearly since the COVID correction of 38%, we haven't seen a single 20% corrections, which used to be far more often before. But 10% is more normal. It's usual for markets to correct 10%. Unfortunately or fortunately, for almost 27 months between June 22 and September 24, we had no 10% corrections, and that sort of would have misguided the investors that can make money in equity markets without corrections, I think, and without suffering the short-term pain, would have led to a lot of pain recently when the markets eventually corrected here of almost 10 to 11% as we speak. But the point being that there are two constants: wealth creation and correction. And this correction has been a little more deeper in specific segments of the market. And to that extent, it feels a little more deeper. But otherwise, as on January 9th, when we saw the market at a Nifty 500 level corrected only 10.3% for its 52-week high. But 289 companies have corrected more than 20% from their 52-week high. So maybe that's why people feel it a little more. But nevertheless, it's a just, I would say, a norm for market to correct every now and then. That brings me to the outlook and what to expect. That was more a longer term picture of the market. Near term, again, we had a fantastic 4 years. And especially when I see between 2020 and 2024, while the GDP growth rate was not extraordinary, it was in line. It looks very good relative to the other part of the world economy. 10.1% is the nominal GDP growth rate. But I think exceptional part of the markets for last 4 years have been the PAT growth rate of 35.4%. That's been a fantastic number, which has been helping the equity markets. And that is the case because while the GDP growth rate was comfortable between 2010 and 2020, the PAT growth was very, very weak. If you see this. And because your PAT growth was very weak, your profit to GDP was coming off for almost a decade from 2010 to 2020. When it went back to normal levels, we feel like earnings is very strong. But this earnings growth rate was strong because it was normalizing, especially in PSU banks and corporate banks and others. Banks been a big driver of this downtrend as well as uptrend. And to that extent, that will normalize and the earnings will normalize back to 11-12%. The other big driver of profitability or the alpha for the funds and the investors has been also that there was a continuous decline of cyclicals and capital intensive businesses that have bounced back. And there was a decline in financials, which is banking, that has also bounced back. Now, these two segments of the market were not performing till 2020. The only part of the market which was performing very well was this defensives, and that was expensive, crazy expensive. Others were very cheap. It was an easy call for us in 2020, 2021, 21, 22. We were overweight cyclicals and financials. We are today more overweight financials, less overweight cyclicals, but we still like cyclicals and capital intensive. These were the two areas where we had most of the money. We were very little in defensives. So we generated a lot of alpha also. Now that is also gone. A lot of alpha has been generated, and to that extent, now uh, the valuation gap is not as high as to believe that you need to be in one versus other. Today, to be very honest, the area where we like the most is financials. I'll come to that in a while when we'll see where our portfolios are. So last 4 years have been strong, both in terms of beta plus alpha. Uh, the issue is the next 4 years would be low on beta and low on alpha, and to that extent, people have to normalize, because if you see here, uh, this 4.8 is also will come down gradually. So it's not that 4.8 will go to 5.2 and go to 5.6. It's not possible. And to that extent, that normalization will make sure that the profit growth rate over next 4 years would be more in line with the nominal GDP growth rate of 10 to 11, 12%. That's what the beta market will deliver, because markets returns are more linked to the EPS. So you had a strong EPS and strong Sensex return between 2003 and 2008, between 2019 and 14. At the same time, we had a low EPS growth rate and low returns between 2008 and 2019. So we are talking of a more 10 to 11% is the good expectations to have from the markets, and some beta, some alpha can be generated on top. As I said, we still like private capex part of the story, given that they have had a very strong operating cash flow over last 4 or 5 years, whereas they have not invested all that back. And to that extent, the debt equity has come off. That has also meant that the NPS for banks, a lot of recovery has happened. So the bank's NPS is also sitting at an all-time low. Both augurs very well for the private sector capex. So to summarize, I think it's more bottom-up than theme and a trend. We would find winners and losers in every segment of the market, be it financials, be it cyclicals, be it capital-intensive businesses, be it defenses. So all the areas would have winners and losers, and we'll have to be more vigilant in terms of what we own and what we not own. Given that we have had a very balanced budget where capex is also okay, and consumption is also been given some boost. So that's where we stand. And as I said, one needs to tone down expectations on both counts, absolute return as well as its velocity. We made a lot of money very fast in 4 years. I think that's not sustainable, and that's going to reverse. Yeah, so we are here to help you. We have the team, a lot of team strength, which is focused on bottom-up stock picking, focused on identifying businesses and management, which are good business, good management available at reasonable valuations. We're continually looking for companies with strong PAT growth rate and ROE improvement. These are the two factors which we look at. When we talk of BMB model, it is all about identifying businesses with somebody who can grow meaningfully and sustainably, both. We're looking at strong earnings growth rate, but also sustainable. And to that extent, we're looking for businesses where we can grow earnings stronger than the underlying economy for a long period of time. And that is something we sort of achieved in the last 4 years, but that is the endeavor to do it ahead also. And last but not the least, buying them at a reasonable valuation. So we're looking for growth, we're looking for quality. Improvement in ROE is a reflection of improving quality of earnings and the reasonable valuations. So with that, I will stop here. And it was, I understand it was simple, but very, very relevant. And if I were to again summarize for all of you once more, and then I'll hand it over back to Shardad, is that the markets have had a strong rally in last 4 years, and that has helped corporates to deleverage, have banks to improve their balance sheet. So in a way, we are in a strong footing as we speak. Demographics still remain favorable for us. We will have a reasonable good growth relative to the world, and the market's correction is now made sure that any froth, any overvaluations have also to some extent come down, not fully. We need to be vigilant, and we need to be prepared for the market corrections, given that the world remains that much more volatile, if at all become more volatile than where it was last year. I'll stop here and back to you, Shardul.
Yeah, Anand, thanks for that. Detailed run through. So what we've done is that we've got a few questions beforehand while we are taking some feedback. We've got some questions here as well. So we're just gonna take common threads. So we've pulled about five odd relevant questions which will cover most of the threads. Unfortunately, right, we can't have discussions on stocks, so that's the caveat from the beginning. So Anand bhai, one key question which is coming, which is that if you can throw some more light on the research and investment process and philosophy. Basically, we've seen the portfolios, we've seen what they bring to the table, but just a bit of how do the portfolio get created, how do these 35 stocks end up in the portfolio, if you can throw some light.
Yeah, so as I said, we have a defined investment philosophy, uh, and given that ICICI Prudential is huge in the mutual fund side of the business, also an alternate side of the business, we have invested enough in the capability, both in terms of people as well as systems. So we have a very large research team, and apart from that, we have a strong investment team. So to that extent, every stock that becomes part of the portfolio goes through multiple filters, multiple times of selection and elimination before it becomes part of the portfolio. So I think that goes without saying that when you're investing with ICICI Prudential, uh, the 25 years plus experience of managing money, doing research on companies, that all comes handy, and is part and parcel of this portfolio creation on the PMS AIFs. So uh, it's a basically a boutique product, but within an institutional setup where we have multiple people looking at the portfolio even after it's created, which is in terms of risk management, boards, everything else. So I can go on and on about the processes and the people behind it, but the point being that when you come to ICICI Prudential, it's a given that uh, there are multiple people who are you know looking at things to make sure that the risks, both on the operation side as well as on the investment side, are sort of evaluated, discussed multiple times uh, before it comes and becomes the end product.
So, Anand bhai, request your view in terms of for the next, let's say, 1 to 3 years. Are there any themes, larger themes or sub themes, given the current developments over the past 6 9 months, which you've seen? We've seen, over the past 2 3 years, a certain, category or a certain theme doing well. What's your take on the next 1 to 3 years in terms of any themes which you feel, broader themes which you feel can do well?
So yeah, as I said, there are themes. Uh, we are very clearly overweight certain and we are underweight certain. But as I said, I don't want to restrict myself on a certain theme and not look at others, because now, after 4 years of outperformance of a certain segments of the market and underperformance of the certain segment of market which was doing well before that. So you can imagine, right? 2010 to 2020 was all belonged to B2C businesses, whereas manufacturing and allied businesses did very badly. But 2020 to 2024 has been very opposite. All the stocks that did very well have underperformed or not performed, and the stocks which were untouchable in the form of PSUs and metals and others, they have done extremely well. And to that extent, I again repeat, rather than looking for one theme versus other, there will be opportunities bottom up in each themes. So we continue to like, say, power. I mean, demographics of India: 1.4 billion, 1.6 billion people, and the electricity demand will continue to grow. We will need investments in that area. Within that, there is a transition of energy from coal to renewables. So those underlying themes are there. The other underlying theme, which we have, so again, as I said, reach out to us, to any of us, and you please go to our website. You will get our annual outlook on which we have written few themes also. One of them is banking, financial services for sure, that we like. Uh, Power, I said. I think the other one, which within the consumption space, there's a strategic shift that we are making is from products to services. Because as any economy which becomes prosperous, and especially the top 20% of the population, as their per capita income moves up, uh, that there will be transition of the percentage of spending in products will stay there. Actually, the absolute spend on the products will remain there, but percentage of the total spending will come down. Will consume more on services, be it telecom, be it healthcare, be it financial services, be it tourism, travel. So you can see in and around us itself that now we are spending more time on telecom, more time on entertainment, more time on travel, and less on the soap and the shampoo and the toothpaste. I mean, we continue to consume that, but much lesser percentage of our income are going there. So it's a very natural thing. As per capita income moves up, uh, on the basics and on the groceries and on the FMCG will consume only so much. Incremental expenditure happens in the other segments of the market, which includes services. That's another theme that we like. Strategic direction that government has given on urban housing, uh, defense, and those spendings might be directly, the defense stocks might be very expensive, but the ancillary businesses we're looking at. So within manufacturing, we are very, very selective. As I said, we liked manufacturing as a whole in 2020, 21, 22. It was easy. Today, it is not that cheap, and to that extent, you need to be very selective. So yeah, we like many areas. Most of the India will do well, but we'll need to be very stock specific from here on.
So, and by in terms of a lot of questions on, while markets have been volatile, people are, looking at using the volatility to invest. So, just wanted your thoughts on, ideally, while there is no right or wrong answer, the deployment strategy in terms of STPs or, lump sum, in just kind of picking your thoughts.
No, so as you rightly said, there is no right and wrong answer. And to that extent, look, any strategy of investing uh, should be tailored to an individual and his or her own beliefs in the market. And to that extent, yeah, it's safe to say that STP works well because that reduces the volatility, and that's typically one of the objectives. Uh, because returns are anyways good, maximization of return might not be. If maximization return is the objective, then you'll have to really be careful about whether you want to go lump sum, whether you want to go STP. But if reducing volatility of one's returns is important, then STP is a way forward versus a lump sum. So again, please reach out to you know your advisor and sit with him or her, and then you can really take that call. Depending on what is your asset allocation today. If you're fully invested, then you can use STP. If you're not invested at all, then you can do lump sum. What percentage of your money you're investing, all those things matter. So again, unfortunately, there's no one right answer, and that's why it's very, very dangerous to give an answer on this question. It has to be tailor made for individual.
Thanks. Again, wanted to kind of understand your thoughts on, you know, in PMS, right? We have portfolios with varying number of stocks. Some are in, 25, 30, some are at 35, 40. Just your thoughts on, the ideal diversification, how you're looking at the portfolio in terms of the number of stocks today, and, slightly in the medium term, how do you see, it moving? Because obviously we've seen, as markets move, evolved, number of stocks in portfolio kind of vary. So just wanted your thoughts on how you are looking at it from a client's perspective.
Yeah, so I think the the objective of diversifying across multiple stocks is to reduce the volatility uh, of one's portfolio. Look, otherwise, if you have the best performing stock, nobody can beat that, right? The whole theory behind that is that up to 18 to 20 stocks, there's significant advantage of diversifying because it improves returns and reduces volatility. And that goes on, say, from 18 all the way up to 40 stocks, 45 stocks. There are advantages. After that, the advantages, incremental advantages of increasing number of stocks, and that impacting the volatility reduces. So ideally, minimum 20, uh, maximum should be 45, 50. That is the extent of diversification where you get the most bang for the buck. And that is the number in the range in which we intend to stay, depending on what sort of volatility is in the market and depending on what valuations we are sitting on the overall market. So, but there is definitely a merit of having at least a 20 stock. So, we refrain from building 10 stock and a 12 stock and a 15 stock portfolios because they, that's not the optimal. The optimal number is anywhere between 20 to 40.
Sure. Thanks, Anand bhai. This was very insightful. Before we end, just wanted your closing thoughts. I think we are on the right slide, or the relevant slide. But I think for the benefit of this large audience who have taken out their time to be with us, just your closing remarks in terms of what to expect and what should, what is expected from even, let's say, our esteemed investors.
No, so once again, thank you so much. I hope the time you have spent on this call has been productive for you. I would again repeat, and that's my more important slide, and I'll come back to this one. But I think this is one slide which says it all. That equity market is a good vehicle for wealth creation in a long term. At the same time, it has its own pitfalls in terms of it's genuinely volatile. The volatility had been less in last few years, and especially since March 2020, April 2020 correction, the volatility has been very little, and that might have given a wrong, notion to many investors. I'm not talking about you, but generally speaking, that you will make an equity returns without having market correction. I think that's very, very important to note here and be mentally prepared for. With that background, I think going forward, it would be not easy to generate returns. Both investors like you and the fund managers like us will have to work hard. You will have to work hard in the sense that you will have to have time horizon in excess of 5 years. If you're incrementally putting money today, you can't expect that you will invest today in next 1 to 3 years you will make money. If you make money, you'll be only lucky. But theoretically, in equity, never the 1 year and the 3 year are sure. It's always 5 years plus, and it should be 5 years plus even today. If not more, I mean, it should be actually more than 5 years, but at least 5 years it should be your investment horizon. Last 4 years, what we had was great run, not sustainable. So you need to tone down your expectation of returns. You have to elongate your uh, time of return, and then as a fund manager, our team will endeavor that on the base returns that market generate, we should try very hard. We'll work very hard, and that will be required to generate any alpha over the benchmark. So with that background, I think uh, thank you again, once again. Thank you very much for joining us today on this call on a Tuesday evening, and immediately after the budget. Hope we have been able to give you some clarification there. Uh, the market will remain volatile, and one needs to be disciplined and long term in the approach to the market if you want to participate in the equity market story of India. Thank you so much.
Thank you. Thanks everyone. Thank you for joining us. Thank you.